Hey guys, Novice Unicorn here. I am a novice. This is only my trading opinion, and I'm not a professional. So I'm just kind of a video blog for myself about things I learned. Um, this is about position size, and I don't normally draw my videos, but I'm going to do it on this one because it'll make it a little easier to uh, see what's happening. But let's say this is the basis of my opinion here. Your position size needs to be large. If you have any kind of trading system where you are, and this is most trading systems equate risk to position size. So if I feel a trade is risky, I am going. If a trade is riskier or more riskiest, I am going to reduce my position size. And if I feel a trade is less risky, I will increase my position size. And that is kind of correct. The problem is determining risk. The problem is, how do you determine risk? And the way my belief system is that you should determine your stop loss before making a trade. So if I have a chart that's moving here, and I see this level here, and it's currently priced up here, and I say, well, okay, I think a good place to stop is below this level. Well, I can't buy it up here and then set my stop loss down here, because let's say this is a 5% drop. That you are calculating, when you buy there, you are adding 5%, loss as a risk. What would be better is to say, I'm going to buy. I want my risk to be 2%. So when the stock comes within 2% of this price, I will buy it. Or you can say, I'm going to buy it here, and I'm going to set 2% risk downside, so I'm going to set my stop loss below it, 2% below it. Okay? You may miss it. If this thing rips, I missed it. But when the price is up here, you have to use a lot of different factors to determine that the price is going to continue to keep moving, and we can look at those in some other videos. But right now, this is a very concrete thing. I know that there were no sellers below this point, and there were buyers above this point. So I don't know that there's buyers above this point. Okay? So And I had a wave back here. Let's say it topped out right here. Oh, well, gee, it topped out right there? That means there weren't any buyers up there. That means, let's say this is a daily chart. Well, 2 months ago, there was no buyers up there. Are there buyers up there now? I don't know. Let's say this is I trade on 5 and 1 minute charts. But let's say this is a 5-minute chart. Well, if this is, a time period of 2 hours, 2 hours ago there was nobody that wanted to buy this above this level. So why am I thinking that people are going to buy it above here? Not saying they won't. You have to learn how to trade good stocks. But for all intents and purposes, an hour ago nobody was willing to sell this below this level. So the chances that that level is going to hold is a little stronger, barring, automated computer trading. But the point not being whether, I'm not going to explain how to figure out if something's going to go up or down, but the point being is that you previously saw a resistance level here. Why are you going to buy it up here with a 5% risk? Okay? You have to wait for a pullback into a level and say, okay, my risk is 2%. So if this comes back 3%, let's say this is 3% here, I'm willing to buy it at 3% and risk 2% point of downside and trigger. This is most likely going to trigger at that point. Or I can wait until it comes back down a little level and starts to show some support, and then I'll put on and say I have a 2% risk. So the position size is important. That's how you like risk. That's one little caveat to risk assessment. But the position size is important, because if I say to you, you can take 1,000 trades and be right 51% of the time, you have to be right. You're going to have, well, let's say this. You're going to have 400, well, not 499. 1% of 100 is 10. If 1,000 trades, 490. You are going to be wrong 490 times, and you're going to be right 510, right? Is that right? Yeah, 510. That's a heck of a lot of times to be wrong. So let's say that out of these 490 times, the trade turned positive plus 1 to 3%, and then came back on you to break even. Had your position size been larger, that 1 to 3% would have meant something cash-wise. And you'd have taken the 490 trades and maybe made 300 of them were losses. And, you know, let's say you have 700 now positive trades. All because your position size was large enough to capitalize on a 1 or 3% move. And if you calculate out, excuse me, if you calculate your risk reward properly, you can figure out, you can get triggered on less trades. So in my opinion, if I can make, you know, half as many trades, or let's say 10%, let's say I only make 100 trades, but I'm using the same position size. Let's say that this equals $1 million in capital, traded over that 1,000 trades. But if I trade $1 million in capital over 100 trades, I only need 70 of those trades to be positive, and 30 of those can be losing. And if I assess my risk correctly, a smaller percentage gain will mean more money. If I take and trade smaller, let's say I trade small, this is the crux. If I trade small, I have to be more right. That means on a, let's say I take 1,000 trades and I am right by 1% on all those trades. But the 1% is too small for me to make money. I really need that trade to make the small trades to hit 5% to win, to make money. I'm going to turn a large amount of these 1,000 trades into losers, because you have to be 5% right. Hopefully this is making sense. This is what I'm thinking. If I take 100 trades and I only need to be 1% right, I will turn these trades into a much more profitable scenario, because I only have to be a large position equals I have to be less right, and the proper terminology is less correct, but large equals less right. And somebody will say, well, yeah, but if you're wrong, you lose a lot more money right off the bat. That's true. You lose a lot more money right off the bat. Unless you do this. Unless you use proper risk assessment. Proper risk assessment is the amount you're able to lose. And so what happens is, when you are, but here's the other side. Let's say you have a small position. Let's say you have, I'm going to even this out. Let's say these are 1,000 trades that equal 1,000 apiece. Okay, and over here, these are 100 trades that are 10,000 apiece. If you have 1,000 trades at 1,000 apiece, a 1% move is $10. You can't make no money off $1,000. You only made $10 on it. If it moves 5%, you made $50. That's when you get out. But had that $1,000 been $10,000, you know, you're talking about $500 versus $100. Well, I'd take $100 every day. Let's say, man, I make $100 a day. I'll do that. I'll make $365 a year. But if your position size had been smaller, it becomes very difficult to make that money. And so that's why trading, you have bad risk assessment. High risk means you lower your position size, means you can't make money. This is the reason you can't make money. Because your position size, you're taking a risky position, and so in order to do that, in order to take that risky position, you take a smaller position, and when you're right, you have to be more right. You have to be too right. This is I guess what we should say is you have to be too right. Whereas over here, you can be, you know, somewhat right. And it's very easy to be somewhat right than to be too right. Now I know this sounds stupid, but this is like a real key component. And the reason that, you know, well, people will say, "Oh, I'm going to trade options because it can move a lot." Well, you're increasing your risk by buying options, and what are you doing? You're reducing your position size at the exact same time. Not that options are bad. I have my own option strategy which works extremely well, but but unless you understand that raising your risk and then lowering your position size because you've raised your risk is the number one way not to make money. Because you have to be too right. I'd rather take a very large position and be somewhat right. Let's say if you've ever been in a trade where you were like, "Oh man, I was up like 3% or 5% and then I broke even." Or I was up, if you've ever made the statement, "I was up and then I lost money." This is your problem. Risk versus position size. You did not take a large enough size. If you've ever said, "I was up and I lost money," it's because your position size was not large enough. You probably could have doubled, tripled, quadrupled, or multiplied by, 10 on your position size, and you would have been sweet. Because as soon as that thing would have moved, from your position up 2%, you'd have said, "I'm out. I am out." But because your position size was too small, that move was not good enough. You inadvertently increased your risk because your position size was not large enough. Small positions create risk, which is what I've never heard anybody in the investment community or trading community state that, but I know it's a big community. But it's not a common thought. Your position size generates risk. Because risk is your how much you're willing to lose over a period of time versus your chance of being right. And if your position size is very small, you have to be very right to be positive. In essence, your chances of being not right or even in that position size, you're essentially creating risk by not having a large enough position size, because this position has to go someplace dramatically for me to make money. And if risk is calculated on how much money you're going to lose or your chance probability of losing money, then the size matters. So your size matters. And this is the final point I'll try to make here. And that is why this is important. This is the real meat right here. If you have, hey, that's not what I clicked on. If you have a chart, and let's say you calculate that you have 3% points of risk, and your 3 percentage points of risk is based off of a previous low, a previous consolidation period, and the stock goes up and it starts to come back down, and you've done your research. Hey, this is AOI, it's a valuable company, they've been beaten on earnings, or whoever, and you hit this consolidation period here, and it's within, let's say you did 3% of risk. You've assessed that you have 3% of risk. If you buy there, and you're saying that this is the level, the last resistance level, you can't buy necessarily there with 3% of risk. Your percentage of risk is here because you have to, your stop loss, and you should always run a stop loss. People that don't run a stop loss don't understand risk. Well, you know what? I'm going to make this confusing. So let's just say, let's get rid of the percentage point here. If you calculated that 3% is your risk, then you have to buy within 2% of this level here, because your risk has to be below your previous consolidation period. Your risk has to be down here, because if your risk is at the consolidation level, there's a high probability this will bounce off that consolidation level and you get triggered out. Your risk has to be below prior support levels. So let's say you did it right. Let's say you calculated 3% risk. The price right here is trading at 2%. It's trading at 2% to this consolidation period, and you have 3% of risk. It's 3% down here. You say I buy heavy because I know I have 3 percentage points of risk, and chances are this will bounce at 2% loss. You know what I mean? If you're buying something that's on, if you're buying something that's doing this for like a year, your chances are not very good. If you're buying something that's doing this for a year, your chances are much higher. So, and I don't really have a good way to erase that at the moment, but we'll just, scratch it out. Hey, it's a chalkboard, you know what I'm saying? So, you have to buy, your risk has to be calculated, and you generate where your support levels are from previous chart prices and all that kind of stuff. Current day, this could be day, monthly, 5 minute, whatever. But you have to set your risk level below. You have to figure out what your risk level is, and this could be 5%. It's whatever you decide. How much money you want to bet. How much money you want to risk. That's the point. How much money do I want to risk? And there's a risk assessment, which we can look at how to do that. But it's based on volatility, in my opinion. If there's 10% volatility of stock, and you buy here, and let's say this is a daily chart, well, the stock moves within 10% of any time period, then your volatility is part of the assessment of risk. But anyways, the point is position size here. If you buy and you say I have 3 percentage points of risk, what's my percentage of upside? Well, let's say my percentage of upside here, let's say this is 2%. Or let's say I feel that the stock could move up 3 or 4 or 5 today. Well, I have 3 percentage points of risk. I hit it really, really hard. And some players, what they'll do is they'll do half and half. They'll say, I'm going to bet $10,000 on this. So here's $5,000 I'm going to put in here. I'm going to hold back $5,000. If I'm right and it does not ever come back down, I can make money on that 5% move. If your position size is too small, you cannot do that, and you cannot win. So your position size is very critical on what you determine. If I'm going to do a 10 and 10, I got 10. I'm going to 10K, and then I'm going to do 10K on the bottom level, and I have 3% risk on the top 10, and I'll have 1% of risk on the bottom 10, And you know, heck, if that thing moves up 2 percentage points, I'm golden. So I made 2% on 10K, and I broke even on the other 10K or whatever. But this is how you have to calculate. This is how you have to calculate your position size. If your position size is too small, you ain't gonna win. This is the point. And if your position size is large and you don't understand the risk, where your risk levels are at, and support levels versus risk, like, you can't do that back here. Like, I'm gonna put in 10K, and the support level's down here. Let's say this is an 8%. Let's say this is an 8% move. And I'm gonna put in 10K up here, and I'll buy another 10 here. Well, by the way, if this ever comes down, you've already lost 8% on your first 10K. Alright, that's unacceptable. You can't, that's a bad trade. You know? If you said, well, here's the last peak. The last peak is 2% below that. That's your risk right there. You have to set your risk right there. If it falls through, well, whatever. You gotta learn some other trading systems or whatnot. It could bounce off of it, whatever. But the key is that you have to look at your risk and then look at your position sizing and what your strategy is. I'm gonna hit it all hard. I'm gonna put all 20K in here right now, and then I'm gonna wait. If it hits that, if it gets 1% below my 2% loss risk, then I'm out. You know what I mean? If it bounces off it, I'm good. But this part, don't confuse your position size. Your position size does not determine whether you're right or wrong on a trade. That's probably like the key fundamental. You know, your position. Oh, I lost money. I took too much position. No, you lost money because you were wrong. You didn't lose money because your position size was too big. You lost money because you were wrong. So, don't confuse the two. Reducing position size is not reducing risk. Alright? It's reducing how much you lose, but it's not reducing risk. And so here's the caveat. So you have this play out. This looks like a scribbling mess, but it's actually really good. But the other caveat to that is, let's say you are right, and you did this scenario here. I'll just do a little dilly-hoo again. Let's say you are right, and you buy your 10K right there, and you were gonna buy again down here. If this thing moves up 2-3 percentage points, and you exit out of, let's say, half of it, so you sell out 5K. And let's say this thing moved up. Let's say it moved up 5%. You moved out 5K. You made your $250 on that, day trade or whatever. You have 5K in the pocket. This thing has to drop dramatically for you to lose your money. All right? Because at this point here, at this apex point here, you are plus 500. Okay, you sold off half, which means you have 250 in the pocket. All right, in the pocket, as my son would say. You are plus 250 in the pocket, and you only have 5K in here. In order to lose, and that 5K is also plus 250. So in order to lose $500 on 5% or on 5K. This would actually be at 550 right, or 5250 right now. You have 5250 in there. In order for you to lose $500 on 5250, this thing has to drop more than 10%. It went up 5. In order for you to lose all, actually it's dropped more than that. I think it's 12 actually. But I'm not going to do the math right now. But in order for you to lose all your money, this thing has to drop more than 10%. So a 5% move is offset, the risk has to be offset by more than a 10% loss. That is really hard to do, because it would have to give up all of its move up, and then double that down. Okay? All because you took a proper position size. Had you done the same thing and I know this video is getting long, but let's just say you did. Let's just say you did. Yeah, I know there's a lot of scribbling going on here. Let's just say you only took $1,000 and it moved up 5%. You'd be plus $50. Well, if you pull out half of that, you've made $25, and you only have 500 and let's say you only have 525 in there. Okay. The thing, if it moves up another 10%, it has to move up another 10%, you'll make $52. Okay? That's a huge move. 10%, it already moved 5. It has to move a huge amount for you to make any money at all. And so in this position size, your position size was so small that means you literally have to pull all your money out right now, and you only made $50. And you were 5% right. That's the way I like to think of it. Percentage move, in my opinion, is how right you are. The more every percentage point that moves is how much equals how right you were. So you can see in this scenario, let's say you had 10K back. Let's say you had 10K. Your full account was $10,000. What's the smarter play? What would have been the smarter play here? To put the entire $10,000 in? Other people are, whoa, that's too risky. Whoa, calm down. That's too risky. You put your entire portfolio or position, trading account in one trade. I'm sorry, my friends, but this is the more risky play. Because you had to you had to hit a 5% move, and even if you were going to move out of the position, it would have to be an astronomical move upwards in order to make any money at all. I mean, barely anything. The smarter trade would have been somebody would be like, oh, I have $10,000, so I'm going to trade $1,000 at a time. Here's an idea. Make one trade, one good trade that's a 5% move, and bank that thing out and keep the money in there and make another $500. If it moves 10% on you, you're going to make another make another $500 versus $52. Make a good trade. And this is the final point. This is just an extrapolation of the final idea. But the final idea is that when something moves on you, if you say this is your max risk, you can't buy here. You have to buy here, and it has to be based on how much risk you're going to take to the downside, and you have to base it off of what's back here. Previous price does matter. People do, oh, you're going to charge blah blah, technicals blah blah blah. Somebody was willing to buy it at those levels, and somebody's willing to sell it at these levels. It means something. So, if you have a heavier buy allows you to scale out properly. And you can scale in. Someone be like, okay, well, I'm going to risk 5% on my first position. I'm going to risk 3% on my second position. I'm going to risk, let's say, if it would get down here, I'm going to risk 1% on my last position. And this is hit here. So let's say I'm going to trade 10K. My first position in will be 2. My second position in will be 5, or let's say 2, and my last position in will be 6. I'm risking less percent. But the entire trade was determined already on my risk, my max risk. My max risk is here. If the thing turns on me here, great. If it turns on me here, awesome. I didn't get my 6% in. Dang it. But I'm positive on my other 2 trades, and my risk assessment on the total $10,000 was I'm not going to do the math because I'm not trading this, but if you calculate, if you take that $10,000 on all 3 of those trades, and said my max risk was 2% overall, then if it gets down to this point and I put it and I load in the last 6% and I have 1% down, or the last 6K, and on my downside's 1%, let's use a $60 risk on the first one. You have 3% risk on this on 2,000. You have $60 risk on this one, and you're risking 5% on 2K. So you have 100 in there. So you have 100, 60, and 60, right? 120, 220. So you have 220 in risk. That's all right. 220 in risk. In this scenario here, had your risk said on my risk assessment is 3%, and I put 10K in, I have $300 of risk right here on the same trade. But I waited and I hit it really hard. So scaling in, people say scale in, scale out, put your position sizes small, blah 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 blah. When you buy and how much you buy, this all needs to be figured out. Like, you need to figure out, like, what's my max position and how many trades am I gonna make to get that max position. But it's all based off of setting a risk level. I prefer it depends on what I'm trading, but I really prefer this style of looking at something, and then boom, and then hitting it really hard. You miss trades a lot, but when you are right, you only have to be a little bit right, and you win a lot. The key to this, in my opinion, is when you have something, and you have something that's moving, and you bet really big. Let's say you bet really big here, and let's say this is dip right there. Yeah, it's not really great. But let's say it had dipped somewhere in this area. So that's where you bought it. You bought it on the bottom of the dip, and you were like, I buy heavy here. There's 3% of risk downside. I don't know any professional trader that takes more than a 7% risk. But let's say there's a 3% downside here, and when it moves up, I can move out a smaller position to make money. If this was 10K and this moves 1% up, I could pull off half of it, and make my $50. Or let's say it moves up 2%. I can pull off half of it and make $100 for the day. I'll take $100 for the day and have $5,000 to ride, and just let it ride. My stop loss turns into my buy. Or in this case, right below your buy. You never want to set your stop losses at levels. You always want to set it right below the levels, because that means the computer really has to punch through all the orders to hit it. But I know this is a long video, but this is extremely important to understand. Position size is critical, particularly when you hit a winner. Because when you hit a winner, if your position size is not strong, you cannot do anything with it. Your options are pull it out or let it ride. I'd rather pull out half or a quarter or a third, make my money, and let it ride. And this is the example right here. I made my money. Boom, I'm out $500. Made me $250 if in my previous example. This is plus 500. This is if this was a 10K order. And there has to be an incredible amount of downside in order to eliminate that gain. Incredible amount of downside. If it continues to go up, you scale out a little more. It makes it even hard. It's the perfect scenario. And just so you are not saying that I'm BSing on this, this is a trade I did in Applied Optoelectronics. I had a boom, boom. My stop loss was actually set. Actually, you can see it right here. This red 57.79. My stop loss was set right here. I made an order. I sold a little bit. I bought. Actually, there's two buys right in there. I bought. Good news came out. I hit. This order was as much as all four of the other orders all combined. Boom, popped hard. I sold a little bit. I bought some more. Sold a little bit. Man, bought a little more, sold a little bit, bought a little more, and sold it right after there. Just intraday issues happening, it just wasn't moving. But my final sellout was here, and my average buying in this trade was, we'll just go in the middle here. My average buying in this trade netted a 40% return. And if I had not had a massive position in that before it moved, I couldn't have done anything with it. These cells were large position cells. The buys were just adding a little bit of money onto it just for the fun on the ride up. So you can actually see it here too. I had a huge position buy right here because of good news, and I sold it at the top the next day for a 90% gain. And then you can see here, boom, there's a little buy, sell out there, sell out there, sell out there. So that position there, I sold. I bought again because I thought it might keep moving, and I sold it pretty quickly after that. But this is the exact perfect example of what I'm talking about here. If my original position to buy, my initial buy position, this was after hours buy, but my initial buy position on their earnings was too small, I would have sold everything right there and been out. But I sold maybe a quarter. And that's all because of my maximum risk was set below that level. That's the reason I was like, well, the maximum going down is, a few percentage points. Let's see, what was it? 5. Well, my max risk was not 5% on that trade, but it was fairly large when I went into it. But that arc of selling that went through that huge push up could not happen if you didn't put on a very large position to start with. So you have to find a winner. You have to hit it as hard as you can. Small risk or small positions equals larger risk. Good luck, guys. Subscribe, thumbs up, all the YouTube normal fancy fare if this helped you out at all. Good luck. Trade large and trade right.